I'm John Kaiser. It's January 17th, 2025. I'm at the Metals Investor Forum in Vancouver. With me today are Joe Ovsenek, CEO of P2 Gold, along with Ken McNaughton, the VP of Exploration. Joe and Ken, welcome to Vancouver.
Morning, John.
Okay, I've prepared a series of big questions, so I'm going to read them rather than just dream them off the top of my head. P2 Gold optioned the Gabbs Copper-Gold Project in 2021 on fairly stiff terms from Waterton. At the time, copper was over $4 a pound, but gold had dropped back below $2,000. In what way did you at the time think you could improve the underlying fundamentals without counting on higher metal prices? And 4 years later, what ways remain to improve the mining plan?
Okay, well, looking back 4 years ago, when we looked at Gabbs and picked it up, we saw two things. First of all, it had a 1.8 million ounce inferred resource, gold equivalent, but 1.2 million ounces gold, the remainder copper equivalency. And we could see, looking at that there was potential just on the geology and without getting on the ground, potential 4 to 5 million ounces of gold equivalent in that surface, on those surface zones. So that was a big factor in getting us in. Another factor coming out of the Golden Triangle was infrastructure. It's always a trade-off. Grade is king, but if you don't have as much grade, infrastructure really helps. And we have pavement from Reno right to our project. We're about 45 minutes away from the town of Hawthorne, where we have our office. There's water on the property. It was permitted up through the early 90s. We're looking to re-permit that now. And there's power. We've got power on the property, and we've got a major transmission line right to the border of the property. So you look at all those things, there's a lot of value there and a lot of potential to build a mine. Now, looking at it now, at this point in time, well, we still have expansion potential. We're up to 3.5 million ounces. We could still go 4 to 5, maybe more, and that's with the known zones without blind targets or deep exploration. And there's also potential to increase grade. And so those are the factors we're looking at now as we move forward towards production.
Anything to add to that, Ken?
No, Joe did a good job.
All right.
For a change.
So one of the things you've done is work on the metallurgical aspects of this project. And the milling flotation plan for the deeper sulfides, where the recoverable value of the copper content is higher than the gold content, seems to be settled. But your plan to heap leach the oxide cap, where the gold value is higher, has room for metallurgical improvement. When investors hear Nevada heap leaching, they think of a low-grade oxidized deposit in the Walker Lane, like Westfall's Hasbrook, where gold recovery will be 70 to 80%, while silver is below 60%. The oxide cap at Gabbs has a 78% gold recovery, and the copper is 54%. Why is heap leaching a gold-copper deposit more complicated than a gold-silver deposit? And where do you see room to either lower the OPEX or boost the copper recovery for the heap leach scenario?
So a couple of things here. I'll jump in a bit, and then Ken will get you into the specifics of the metallurgy. But if you look back, this project had a lot of work in the 80s and early 90s. And the big issue then was you have copper and gold, as you mentioned. Always causes problems. It uses more cyanide on the leaching, and it also interferes with the recovery of the gold, and you can't recover the copper. So in the late 90s...
Couldn't recover
the copper. So at that time, late 90s, they came up with this SART process in a couple papers that were written early to mid 2000s. The first plant went in at Telfer in Australia, and since then there have been a number of plants. And these plants are called SART plants: sulfidation, acidification, recycling, and thickening. And what they allow you to do is recover the copper and recycle the cyanide to bring your costs down. Now, on the metallurgy side, Ken will jump in on our...
Well, just quickly, it's Walker Lane gold, so it's free gold. In our bottle rolls, we actually get up into the 90s. So we think there's still another 4 or 5% recovery on the gold, just with better cyanide management, because the copper's there and the copper's being dissolved at the same time. And then secondly, with the copper, the same thing. making sure our initial column tests were all starved of cyanide. We know that from a bunch of factors. So we're looking at our next round to optimize our cyanide additions and use a couple other little things to tweak to kind of boost our copper recoveries, hopefully into mid to high 60% from 54, and then get the golds up into the low 80s.
Okay. The timeline in your corporate presentation shows that during the first half of 2025, you will be working on the metallurgy as well as environment and water. What is this environment water work about? The timeline also shows that a plan of operations application will get underway in 2025 and stretch into early 2026. Can you do any exploration or feasibility study related drilling at Gabbs before the plan of operations is approved?
We have a bit of room under our current permits, our notices of intent to drill. We're allowed 5 acres of disturbance. We have 2. We have about 1 acre disturbance on one of the permits, so room for 4, and 2.5 acres of disturbance on the other permit out of 5. So we have a bit of room there, but to evaluate the whole property and do our geotechnical drilling for where our mill is going to go, our heap leach pads, we need that plan of operations.
Yeah.
Okay. When you optioned Gabbs, you felt that significant untested exploration potential remained at depth below the Gabbs cluster of deposits, but never has the capital to test these deeper targets been available. Suppose Trump discovers that America has a metal import supply vulnerability and puts his weight behind not just fossil fuel exploration, but also for metals and minerals. Obviously, you want to raise money for the feasibility study work, though that leaves your stock price stuck in the value trough of the Lassonde curve. The markets might say, we will give you a lot of money for your feasibility study, but only if you spend some of it on discovery drilling at Gabbs. What is the discovery potential you see at Gabbs, and how much money would you need to make or break that potential?
Twofold on the exploration potential, or threefold. We still have the existing zones are open for expansion. That's easy, low-hanging fruit. There are a number of showings around. Some have a few drill holes on new zones near surface, which we could go in and test quite easily. And then on that deeper zone, our experience over life is don't just rush slamming, 1 kilometer holes down, going to look for things. There's some structural regimes that come out of Lucky Strike and head over to, Gold Ledge? Don't use that name very often. Any rate, so what I would like to do if the money were available is to systematically follow these structural trends, which I think are conduits from the deeper porphyry up to Lucky Strike, and chase those back to where geophysics, ours, and the old Newcrest data suggests there's a porphyry system, and it's likely sitting under Gold Ledge. But we've also got gold targets off to the south, which we don't understand why they're there yet, and we've got lots of things to scratch around at.
So if we got into a proper bull market like we haven't seen for over 13 years, if you got a lot of money, there's a lot of potential there that has never been tested.
Yep.
And that could deliver surprises even while you're plodding through
Near
feasibility
surface,
demonstration work.
near surface, and at depth. That's right.
And near surface, $2 to $3 million gets it done.
Oh, I can always spend money.
Yeah,
I mean,
let's
come on.
slow down. That's my job is to curb and spending money. So $2 to $3 million.
2 to 3 would be a good.
We could
good
really
scratch.
evaluate the property.
Yeah.
This is probably a question for Joe. In your presentation, you present various price cases for the May 2024 PEA update, in addition to the base case prices of $4.50 copper and $19.50 gold. But none of them tell us what the NPV and IRR would be at the current prices of $4 a pound copper and $26.70. Actually, that's now over $27.00.
27.20 this morning.
Which makes it tough for us to see how Gabbs is amply clearing development hurdles at the current prices that we have. Obviously, you can plug the spot prices into your discounted cash flow model every day to see where IRR and NPV stand. But unless I have your spreadsheet, which will not happen because such models are proprietary, I, as an analyst and investors, are left in the dark. Is there any reason why a company should not be allowed to have a web page of the key DCF outcomes, which features the base case outcome from the published 43101 study, plus the economic outcomes generated by spot prices that are updated daily or weekly? Obviously within a time limit of the PEA's publication so that we don't have the problem of costs becoming stale.
Right.
Why is this not being done? Is it against the rules? And if they are, why do these rules exist?
I've never had that raised. I think that's a good idea. I think maybe, Ken and I will chat, and I think we'll start doing that. If I don't see why, as long as the PEA is current and the data is published, all the other data is published, I don't see why we can't just update it with spot prices. And speaking of spot prices, in prep for coming to this conference today, I ran the models for Gabbs at 2,700 gold, $4 copper, $30 silver. We're just around 37% IR. We've got about 1.2 billion in NPV 5, NPV 15. We're still over $300 million. So this project is robust at a lot lower prices, but at current prices, it kicks off a lot of cash.
Yeah.
Okay, so yeah, I think one of the problems this sector has is you're so limited in, on a real-time basis, allowing the public to understand what the value metrics of your project are. Final question. Since taking over the P2 Gold shell, the key people, you two, Joe Ovsenek and Ken McNaughton, have invested about $10 million of their own money, which is at least 25% of all the money raised. This is despite being key drivers behind Pretium Resources, which Newcrest bought for $3.6 billion in 2022. This is not normal. Heroes usually pay zeros for their stake in their next junior deal. Are you two stupid, insane, or an example of something badly missing in the Canadian junior resource sector?
Well,
I don't know how to answer
we
this.
ask that question every day.
If you speak to my wife, you'll get a positive.
Stupid,
But look, we
believe in the project.
We believe in the project, and we love the industry. We wanted to get back, get another build, and the way to do it is put your own money at work. When you have skin in the game, it forces you to focus and move forward.
Yep.
And this is a reason that P2 Gold is not just a bottom fish spec rated member of my bottom fish collection, but you're also a member of my KRO 2025 favorites. And I wish in the industry we would see more of the successful people putting their own money into the next deal so that the skin in the game is the same, in your case even bigger than everybody else's. I have been speaking with Ken McNaughton and Joe Ovsenek at the Metals Investor Forum in Vancouver.